All you tell the IRS each year is one number, the total value of the asset. You don't have to disclose the assets, and the reporting is greatly simplified. There's no K-1s involved.
I meet with a lot of wealthy clients and clients of means, tens of millions and so on. And one of the biggest concerns they all have is taxes. They're all paying a lot in taxes and they're trying to find places that they can put their money that are going to give them, number one, safety and privacy. They don't want that money low hanging, but they also are looking for some tax advantages. And, after you've gone through the 179 deductions and you've gone through all the other places you can put money, oil, solar, they're looking for long-term tax efficient places. And that's where you specialize. So can we talk just a little bit about the clients you work with, what you do to help them in the tax savings aspect or tax, we'll just call it tax benefits. And just tell me a little bit about how you do that.
Well, we have clients all around the world. So basically with PPLI, you can engage in advanced tax planning and advanced estate planning all in one structure. So in the US context, we're talking about recharacterizing a investment fund into a life insurance fund. So why the heck would you want to do that? Because most people have a somewhat of a jaundiced idea of life insurance. Some bad experience being the Woody Allen joke, being trapped in an elevator with a life insurance salesman would be his worst nightmare. So that being said, once this recharacterization takes place, you take out a policy, the assets in there, all future growth is tax-free. There's no tax. So what most people have been presented in terms of life insurance, at the higher end is just a life insurance policy with a bunch of mutual funds, which they probably already have, or they have more interesting investments than, getting 5% plus or something a year on their account. So in PPLI, you can put in with the right structuring almost any asset. So, and at the end, what's left after you can also draw out the money for a very low service charge, goes tax-free to your heirs. So as you said, it's the best place for long-term money that you have access to, and you can put it into your estate plan.
Well, I think there's some key things that I want to unpack today. I mean, number one, the tax part's really, impressive. And obviously a big reason why, people, wealthy families for that matter, or the affluent look at life insurance as a storage of wealth or a place to put, the majority of their capital. I mean, we could see that from the Rockefellers, the Morgans, the Stanleys. They all believed in life insurance, contrary to what a lot of people today believe about life insurance because of the misinformation that they get. But I think pretty soon they're going to be seeing, the downsides to some of their actions with that. But when we get into it, you talked about estate planning, and I want to make sure that everybody listening to this understands the rules, for estate tax and where the limits are. And I know they bounced around a little bit, but we're sitting still, with the new tax bill. We're sitting in a pretty good place, but that's always in jeopardy of being reduced or being pulled back. So I want to talk about estate tax in its impact, which could be up to 40%. And then I want to hit a little bit on the privacy aspect because, me being, somebody of means, and I would consider myself somebody that would look at private placement, privacy is a huge thing. I don't want people knowing where all my assets are. I want my assets protected. I certainly want a tax efficient vehicle to put my money in. And these are some of the things that I think everybody watching this podcast are also looking for. So can we just kind of start in the beginning of, when did PPLI come into existence? And, since it came into existence, has there been any real changes? And then how does it solve the estate tax issue, or how can it be used as an estate tax planning tool?
Okay, so it actually started in the 1970s. In its first iteration, it was used by executives at Fortune 500 companies because they wanted a broader investment spectrum than they were getting in the company's, standard pension plan. So in the 70s and 80s, it went along just fine. And it still exists in this form, uh, in the form of what's called COLI, corporate owned life insurance.
Mhm.
But then in the 1990s, a estate planning attorney says, hey, we could use this too for our wealthy clients. And then about the same time, uh, jurisdictions like Bermuda, Barbados, the Caymans started writing their laws to favor PPLI. Because in the domestic version, with some exceptions, all you really get is really an expanded version of the life insurance and mutual funds. You get a little more
So
leeway.
so
But,
for some people, they would know of that as a variable universal life or a VUL, correct? Like an expanded version of that?
correct. And then, so in the offshore world, uh, the main difference is you can put what are called in-kind assets. So, with the right structuring, you can put your real estate portfolio, hedge funds, like we talked about before, um, in there. So, in how that dovetails into estate planning is that uh, one standard way to pay the estate tax is to take out a large life insurance policy, just a kind of a pure death benefit policy. And your estate planning attorney would calculate how much your estate tax is going to be, and you buy this amount of insurance. Um, but in the PPLI context, um, that insurance exists in the policy and all of your other assets that you choose to put in them. So all those, instead of being, if it's just buying the term policy to pay for the life insurance, all your other assets can be exposed to that 40% without proper structuring. So here you have everything in estate planning kind of tax-free environment instead of just buying this term insurance, like I said, to pay for the tax. So it's a much more powerful tool. So this is what was discovered, in the 1990s, and then. And like I said, we deal almost exclusively in just offshore companies because the fees are lower and there's much more innovative structuring in terms of what you can do and what you can't do. Because in the U.S. context, you can't really put in-kind assets into the policy.
So I've talked about this very, very briefly with my estate planning attorney, and they've talked a lot about offshore. But I just wanted for the audience kind of unpack this a little bit more. To do an offshore account, we'll call it Bermuda because that's a pretty common one. Can you still reside in the United States of America and park this vehicle offshore? Can you explain how that works?
But almost every country in the world allows their citizens to buy what they would term a foreign life insurance policy, including the US. So, yes, you can be in the US and the assets can be anywhere in the world. Uh, the insurance company just becomes the administrator of the assets. But uh, it really doesn't matter where they're located.
Now, what about the risks? So, outside of the risks of the investments or the assets that are moved inside of the structure, what are the risks of losses? And also, so when you think of traditional life insurance, permanent life insurance, that is, you'd have the life insurance component, and then you'd have the cash value component. Is in this structure the assets that you're referring to, which could be crypto, could be real estate, could be hedge funds, anything like that? are those what drive the cash value growth, or the value of the assets what is reported as quote unquote the liquid asset?
Yes, yes, but going back to the reporting, uh, all you tell the IRS each year is one number, the total value of the asset. You don't have to disclose the assets, and the reporting is greatly simplified. You don't have to. There's no K-1s involved because it's the. Uh, it's like when you buy
Well,
a
it's
piece
life
of
insurance, so it's private.
right, and it's like normally when you purchase real estate, you put it into an LLC. So it's a similar thing. On paper, the insurance company then owns the assets. But going back to the security, and it, in some ways, it's actually it can be more secure than a U.S. domestic policy because uh, the and say a VUL policy, say the U.S. carrier went bankrupt. Well, these aren't the mutual funds aren't what are called separate account assets. They're part of the general account of the insurance company. So you have to stand in line uh, with all the other creditors to get your money. But in the offshore world, what happened in the 90s when these jurisdictions started writing their laws to favor PPLI, they did what was called separate account legislation. So these assets aren't part of the insurance company's general account. They're segregated. So if they were to go bankrupt, the creditors of the insurance company would not have access to your uh, accounts. They would be completely segregated and completely safe.
And now, how would a family, or just a family that you work with, get liquidity from one of these accounts? If the assets that are being held are illiquid, then that's a different story. But let's just say they are liquid investments and they have some form of way to convert it into cash. Like, how would that work for the client if
Well,
they wanted to get money out?
it's all specified in the life insurance regs. So you can take out 100% of what you put in tax free. And then afterwards, you can take it out in terms of what are called in the regulations loans, but you're actually taking out your own money for a small service charge. Most companies usually charge like 25 basis points. And that's not even, you don't even pay that. That's subtracted from the death benefit. Uh,
Well, that's fantastic.
so you basically, if you need to, you could take out 85, up to 85, 90% of what's in the policy during your lifetime. In point of fact, most people don't do that. I mean, they have plenty of other
Other
assets
assets.
that they can go to. But there's two basic structures in the broadest sense. There's people who use it as a retirement account, and then there's more people, say in their 70s, 60s, 70s, who are setting up their estate plan, use it more in terms of a vehicle to pass assets down tax free to their heirs. So there's a kind of can be a commingling of those two structures, but those are, in the broad sense, the two structures that people use them for.
So when it's passed down, it's just passed down tax free as cash, correct? Like a cash death benefit? Or is it passed down as part cash, part assets, depending on whatever is held in that separate account? Or
The
I shouldn't,
latter.
let's not call it a separate account because that's more like VUL, a segregated account where the assets are held.
The latter, because like if there's real estate in there, the company doesn't liquidate the real estate to write a check. They pass the assets down. So that would all be delineated, and usually the most policies are owned by an irrevocable life insurance trust. So that would all be uh, set down in terms of the trust.
Okay, that's fantastic. So I've never really heard somebody talk about it as a retirement strategy. Can you kind of go into that a little bit? So if somebody was looking at this and they were using it more for retirement strategies, how would that look?
Well, they would just like you contribute to your 401k, your IRA. Uh, in one sense, this is unlimited, a Roth IRA with an unlimited contribution. Uh, so, you put in, whatever each year, and then, say in your 20s, 30s, 40s, etc. And then when you want money out in your 60s, 70s, you start drawing it out. And like I said, you could draw out up to say 85 plus percent. And all that money has been growing tax free inside the policy. So most clients have seen these charts in terms of a taxable investment versus a non-taxable. So the way the chart usually works, after 10 years, the one who had the investment that hasn't been taxed, the PPLI, you're a few million ahead. And then after 20 years, that's double. But after 40 years, your money is almost doubled uh, in terms of not being taxed. If you're, particularly if you're in California or New York, where you can be subject to, you know, around numbers 50% to tax. So again, the tax savings is quite astounding.
Okay. So let's talk a little bit of, and one more thing on the retirement structure. That would not be in an ILIT, right? I would assume if you're going to use it for retirement, the structure would be outside of an irrevocable trust.
Uh, no, you could still have it there if you had an untimely death. You would want what was in there to
Right.
pass tax free as life insurance. So, but that wouldn't prohibit the withdrawal up to 85%.
That's what I was wondering. Yeah. If it
Yeah,
was in an
no,
ILIT, you could still take the income for retirement.
correct. Yeah, the main thing that you're getting with the islet is the you know positioning it so it's tax free at death. But prior to that, you still have access.
Interesting. Okay. And now the families you work with, just tell me a little bit about like some of the different reasons. I mean, we already went over retirement. We talked about estate planning, but are there any families that you work with that maybe have appreciated assets that they're looking to move? I mean, can it be done that way? So someone's got retirement assets, or maybe they did invest in a hedge fund and they want to move it into a tax-free or tax advantage shelter. Is that something you can do, or do these assets have to be started within the PPLI structure at the time when it's set up?
Well, part of our service is setting up a team at the beginning that can create a structure that's going to uh, be true to the client's aims and wishes. So we have a whole team of different attorneys and different valuation experts who can come in and serve the client.
And what if a
Um,
family has, their own family office? How would that integrate into this?
well, we try to disrupt as few relationships as possible. So uh, we some of our attorneys are willing to just come in and educate them on the PPLI and get their comfort level up if they've never heard of it. But
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
we're not trying to substitute our team for a client's existing team if they value this team and want to stay with them.
Okay. All right. Let's switch gears a little bit and just talk about how you engage with the client. So, like, what is the basic structure, like, you get referred a client who's looking for something here, and then like, how would that process look, and how would someone engage with you to do this for themselves?
Well, like many things, it usually starts with a phone call.
Mhm.
And in today's world, with the internet and AI, thankfully, most people come fairly well educated. They, I'm not, I'm not at PPLI 101. They know about the basics. They know they've seen probably that they need to go offshore, and they're just looking for an advisor who's experienced and who can uh, fulfill their aims. Um, so after initial phone call, then I we usually have I meet with their physically or Zoom with their advisors, or bring in my advisors, and we talk about how we can do this, and whether it's going to work for them. Because it's much better to thrash all the rough edges out at the beginning. And so, well, one thing I learned about working with clients is that it at the first meeting, clients tell you really what they want, and if you talk over them or substitute what you think they want, every things can go along fine, and then right until the end, the client says something like, "Well, remember I told you at the beginning that I wanted this to happen?" And all this time that they've kind of gone along with you, but then you haven't really fulfilled their wish, right? I mean, but that's what you're supposed to do. Like in sales, I mean, you sell something to someone that they really want, but if you don't listen to them, you don't know what they really want. So,
Point.
so we tried to get all that out at the beginning, because then it gets a bit technical. They have to sign forms. They have to you know for the have a medical for the life insurance, and you know all the transactional things. But I like to have the the big picture and the structure all in place before we get into the nitty gritty and all that. So in the end, the people are fulfilled.
So if a client were to get denied because of underwriting reasons, health concerns or things, what are your options? Do you have multiple carriers you can take them to with different risk tolerances?
Well, it's much more liberal in the PPLI offshore world. Uh, Anyone who is connected to the family, who has an insurable interest in the transaction, any family member, we can substitute a life.
Oh, wow.
So, and even uh, we can, for some families, they continue to do that. So they kind of turn it into a perpetual trust, so to speak, in terms of they we have multiple family members as beneficiaries. And then when they get a little older, we start substituting, the next generation. So the policy can go down several generations.
Yeah, that is very different than it would be here domestically, or, onshore, if you will.
Right.
And what other things could you like? Who would be an ideal client or an ideal candidate for a PPLI? Like, what are some of the kind of knockouts that you would put in place?
Well, in terms of the garden variety estate planning play, it's clients in their 60s and 70s who want to pass things down efficiently. Uh, and then uh, on the investment side, uh, younger clients, 20s, 30s, and 40s, um, it's the big home run there is like a pre-IPO situation,
Mhm.
because if they're expecting a large liquidity event, either in terms of the sale of a business, or some crypto that's supposed to pop, or so once the asset's inside the policy, it's in this tax-free environment. So if you can get it in there uh, early enough, uh, you wouldn't want to, do it the week before, because the IRS has this rule of what they call step transactions. You're anticipating um, this large gain, but you're kind of shielding it from tax in this kind of obvious, in their world, too soon way. So, but if you can get it in there and structure it properly, it's a huge home run.
So
but
what if
it's
somebody, not to interrupt, but just give you a kind of little more context. If somebody had like a company currently valued at 50 million, they were expecting to exit in the next 5 years for 350 million. And they set this structure up. But today, the separate account or the segregated account is valued at the 50 million for the asset and then whatever else they put in there. When the asset does pop or the exit transaction happens, what impact does that have on the death benefit? Does the death benefit adjust with the assets, or are they completely independent of one another?
Well, there are yes and no. I talked about the two basic structures in terms of the client's planning. The retirement versus estate planning.
Mm-hmm.
Well, in terms of the policy structure itself, there's kind of two basic structures involved in that. In the retirement one side, you do have to keep a large death benefit to be able to uh, draw out the money, because in the life insurance regulations, there's very specific rules about the relationship of the death benefit to the cash value. That being said, for the estate planning and for offshore companies, they have a policy design called frozen cash value. So in that design, you can have a very small death benefit in relation to the cash value. But you don't want to do that um, for a younger client, because the rules for the frozen cash value are such that you can only take out what you put in. So all that future growth, it will be passed down as a death benefit, but you don't have access to it. So for the client in their 70s or so, well, that's why I did the whole structure, right? I mean, it's to pass down, and I don't really need access to the cash value, so that's fine. So that being said, for clients, so it's kind of in the middle of that. We have two policies. We have a retirement policy and a frozen cash value policy, and then we, as time goes on, we move funds from the retirement policy into the frozen cash value policy, because they don't need access to it. So
Okay, so someone when they're younger could do the plan that gives them the 85% liquidity, and then as they get older, you could change the structure of the plan to be more just for the estate planning when they don't need the assets or the liquidity.
well, yeah, we would basically take out a new policy.
Oh, a new one. Okay.
Yeah. Um,
And can just like a 1035 exchange, can you move money from one to the next? Or can you take assets from the one and transfer them to the other?
yes, you could. Yes.
Hmm.
Yeah.
So, I mean, it's a whole different world. I'm familiar with it. I've heard it a lot. I've heard the good and the bad of PPLI. I've heard, a lot of domestically, primarily, a lot of companies were setting these up, and then they were, the IRS was coming down on them because of some of the uses of how they were using these. And the way you're doing it, where it's offshore, that it's just fascinating. I mean, I don't know enough about it to even be dangerous, so I'm kind of learning as you're talking, as the audience is. But what other things are considerations that someone would have to look at before deciding to go this route?
Well, like I said before, there's the investor control. So if you're kind of in the bailiwick of a day trader, and you wouldn't want to be putting those assets that you're trading in the policy, because you'd be violating the investor control rule.
Mhm.
And then occasionally, just in terms of the example on the diversification side, if all you want to hold is a lot of Bitcoin, and you can't diversify into like up to say 5 investments, which usually is pretty easy to do. Each investment in a brokerage account could be, considered an individual investment. But if all you want is a Bitcoin, that wouldn't work for you. But I do have an interesting example in terms of like a case study where things went wrong, uh, which would also uh, might enlighten your audience. Do you want me to go
Oh,
over that?
please do.
Okay. So usually we try to uh, up to what we can divorce proof these policies. But so we had a client. He was a crypto investor. He had about 30 million in crypto. So he took out a policy, and uh, you know, everything was fine. He had enough diversification even at the beginning. Um, but then his marriage started going south. So it, if he would have kept the policy, everything would have been fine. But he tried to be what he termed fair at the time. So he wanted to he canceled the policy and only wanted to give half to the his spouse. But unfortunately, the his spouse and their attorney were uh, nothing was whatever he came forward with. They thought he was hiding assets, so they didn't accept this, and they actually it became very nasty, and they kept hired investigators and so on and so forth. So had he kept the policy, he could have just taken a withdrawal, and given her that. But he kind of did this without calling me. He kind of worked directly with the company, which was kind of strange because we had a very good relationship. So, but he, you know, trying to do the right thing was what turned out to be very much the wrong thing for him. So
So at the end, did his wife end up getting a lot more than she would have if you just gave her half?
Uh, well, I mean, I don't know what kind of happened at the very end, but they reached some kind of settlement, and but it's like it, it's uh, it, we're here to serve, So if he would have called me, it would have been much better for him. But I'm not quite sure why he kind of. Well, a lot of the crypto people are super, you might call do-it-yourselfers. They they the crypto world is, we have a fair number of clients, and but it's kind of a a world unto itself. So we actually have some very excellent companies who will have very good custody solutions for crypto. If you have any crypto clients out there. Um,
Yeah, I don't know. I mean, we used to talk crypto a lot, but with some of the volatility in the last couple of years, we haven't really had much of a demand from our community and our client base, for crypto. It's been more real estate, and real estate's been a bit iffy lately just because of the liquidity crisis that it's in. With entrepreneurs, business owners, and things of that nature. So on that topic, like no matter what realm the person's in, like where would it start where PPLI would start making sense? Like from a net worth standpoint or an asset standpoint, is there like a level that you say, okay, well, if you have less than 5 million or 10 million, it probably won't make sense. But if you have north of this, it starts to really look favorable. Like what is that number?
Well, the minimum amount that the offshore companies will accept is 5 million.
Okay.
So, but usually most of our clients are put in, more like 10 to 20, and their net worth is, north of that, because we don't encourage people to put all their assets in the PPLI.
And you've been doing this for how many years now?
She's just specializing in the PPLI, like
Yes.
over 20, maybe 25.
What'd you do prior?
I actually started out in property casualty insurance.
Really?
Yeah, and I ran a agency, and then uh, the the one of the companies said, "Well, you have to sell life insurance." I said, "Oh, I don't want to do that. I'm happy doing what I'm doing." And then they called up and they said, "Well, if you don't do a policy within the next month or so, we're going to cancel you." And I said, "Ugh."
Wow.
So then I, my first client was a chainsawyer. He was one of these guys that they helicopter in to a forest to cut down trees, and then they helicopter the trees out. But not just him. There's multiple people. And so I thought, well, I'll do this application, but are they going to accept this person? I mean, talk about high risk. So, so I put it in, and it came back. It was approved. He was a great candidate. He had 6 kids, and so then I called up the company. I said, well, I didn't want it to be canceled later on. I said, well, you know what this guy does, and they said, yeah, but we don't underwrite for profession. So I said, oh, that's good. That was so I sneaked through
Yeah, because that would
one.
be high risk for sure.
Yeah, right. So that was my first client. So then after that, I did the garden variety life insurance, and then I started working more with estate planning attorneys and doing more in the 90s, kind of the typical play for a husband and wife was a second to die policy.
Oh, yes.
So
I remember those.
after
Still
the-
do.
Right. So I did those. And then in the early kind of 2000s, I started going more international. I started writing a newsletter, attracting more sophisticated clients. And then, I came upon the PPLI in that context, international.
That's an interesting road. But yeah, I can see where that would happen as you start getting into the estate planning world. You start learning things really quick. I used to do a lot of that when I was an advisor, and we did a lot of estate work. But 19 back in the 90s, what was the estate tax limit back then? There was a point where it was really low. Was that the 90s or the 2000s?
In the 90s, yeah, it was just a couple $1,000,000.
That's right.
Right. And,
Yeah, so estate planning was very prevalent, and very, very talked about across the realm in the industry. But then they increased the limits to now. Where are they at now? I know they just went up in 2026. What for a couple?
well, for a couple, it's we're getting up to like 30 million,
Okay.
like 15 each. So, but like you said, I mean, the is the the blues take over.
You could say that. That's all right, because that's
Yeah,
right. They were trying to get rid of that. They were trying to
It's
roll
high.
that thing
It's
back.
high. It's high on their agenda to knock it down for more tax dollars. So it's always a dance between the you know, the reds and the blues in terms of taxation.
100%. So if somebody watching this wanted to engage you and do a call with you, how would they go about doing that?
Well, go to our website, ewp-financial.com, and the phone number is on there, and just call me up. Like I
Perfect.
said, I usually things start with a phone call to see if, it's a good fit. And if it is, then, we keep talking. And the one thing we haven't discussed that clients frequently put in are collectibles. They do very well there.
Yeah, that actually would make a lot of sense. Like even collectible cars, like a car collection.
Anything. I mean, like I said, the insurance company is in us. I mean, the whole investment risk is on the client, but in terms of assets, if they're structured right, we can put almost anything in there.
That's pretty fascinating. Yeah, I never would have thought of collectibles, but that does make perfect sense, and there for anyone listening to this, there's lots of information you could find, and there's several different podcasts or YouTube videos about why you always hear about wealthy families, investing in collectibles, things like the pictures and the paintings and just the things that you look at and like, why would they spend that much on that? Well, dive a little deeper into it and you'll start to understand that aspect and you'll go down that rabbit hole. But then I can totally see where that would be a huge fit for PPLI and one of the assets.
Well, yeah, in one sense, for some clients, it's just their passion, and for others, it's a form of diversification.
Mm-hmm. Absolutely. Anything else you wanted to share with the audience before we end the episode?
Well, what I always tell clients, you need to understand what you're getting into. If you don't understand it, don't do it. So our role is to explain it to clients where they understand it, and then they can move forward. But I think that's a good basic rule in terms of investing.
Yeah, we always tell people invest in things that you know, like, and understand. And if you're going to get into something, make sure you do the proper due diligence to understand it very well before ever putting a nickel in it. I think a lot of people during this bull run, longest bull run in history, it's just people have gotten very foolish and invested a lot of assets and money and things that they do not understand. And they're well, some of them have got their hands slapped pretty good. And I think the rest are about to have a wake up call here as we go into this next cycle, or what it appears to be the next cycle. I think it's going to be an interesting one, but one that'll favor very well for what you do, very well for what I do. So I guess whenever it happens, it happens.
Well, good. Yeah.
Absolutely. All right. Well, Mike, thanks so much for joining us. We'll put that information for anyone that's looking to get a hold of them to kind of start that discussion right up in the description. We'll have that website up there and just go to the website. Phone number's right on there. And give Mike a call, Mike and his team, and they'll walk you through it. With that being said, go ahead.
Yeah. Thanks for having me, Chris.
Oh,
yeah.
Thanks for being on. And folks, thanks for joining us for this episode of Money School Elite. We will see you on the next one.